The income statement, also known as the profit and loss statement, is a financial document that provides a summary of a company's revenues, expenses, and profits over a specified period of time. It is an important tool for investors because it helps them to understand the financial health and performance of a company. An income statement typically includes several key components, including revenues, cost of goods sold, gross profit, operating expenses, and net income. Revenues represent the amount of money a company earns from its sales or services. Cost of goods sold, or COGS, represents the direct costs associated with producing and selling a product or service. Gross profit is calculated by subtracting COGS from revenues, and represents the profit a company makes before accounting for operating expenses. Operating expenses include things like salaries, rent, and utilities, and are subtracted from gross profit to arrive at the company's operating income. Finally, net income is calculated by subtracting any additional expenses, such as interest and taxes, from operating income, and represents the company's overall profit for the period. Investors use the income statement to evaluate a company's financial performance and to make informed investment decisions. For example, investors can use the income statement to compare a company's revenue and profit growth over time, and to assess whether a company is generating enough profit to cover its expenses and provide a return on investment. Additionally, investors can use the income statement to evaluate a company's efficiency and profitability by comparing its gross profit margin, gross profit as a percentage of revenues, to that of its competitors. Another important aspect of the income statement for investors is analyzing net income and earnings per share, EPS. Net income represents the overall profit of the company and EPS represents how much profit per share is allocated to each shareholder. This information is crucial for investors to assess the overall profitability and performance of the company. Additionally, investors can use the income statement to identify any potential red flags, such as a decline in revenue or a significant increase in expenses. This can indicate that a company may be facing financial difficulties, which could impact its ability to generate profits and pay dividends to shareholders. Furthermore, an income statement can be used to assess the liquidity of the company. Investors can use the cash flow statement, which is closely related to the income statement, to understand the company's ability to generate cash and pay off its debt obligations. In conclusion, the income statement is an important financial document that provides investors with a comprehensive overview of a company's financial performance. By analyzing the income statement, investors can evaluate a company's revenue and profit growth, profitability, efficiency, and overall financial health. This information is crucial for making informed investment decisions and assessing the long-term potential of a company. Use code BLOG to receive 25% on your next purchase.